And welcome for this third session in the Chip Think Tank, which is brought to you by Access. And the Chip Think Tank is a series of webinars that is, we want to invite people, industry leaders, opinion leaders, to share with us some insights and reflections on the semiconductor industry. And you will have that on a monthly basis. I am Régis Samlin, I'm CTO of Blue Morpho, and I'm the coordinator of the project Access. And today I'm pleased to welcome Mr. Jean Schmitt. You are president and managing partner of Jolt Capital. So thank you very much, Jean, for being with us today.
Hello, Régis.
Hello. So a few important information before we get into the discussion. All these webinars are recorded and will be uploaded on our YouTube channel. You have here a QR code that will guide you to the channel. You can register and then you will hit the bell and subscribe. Of course, that's what you say when you are a YouTuber. So the Access project, we are 7 partners and we are working for 4 years. You have here the list of partners representing a good proportion of Europe. And our job is to coordinate the 30 competence centers, which are here listed on the map. You have about 1 or 2 competence centers per country, which are hubs of excellence to provide services to the European industry. And we want to facilitate also the access to the pilot lines and the design platform to create this European network of CHIPS Competence Center. So this is our mission. A few news before we get into it. I will be next week at the Global Semiconductor Conference in Malta. I will moderate a panel. Check it out. It's a very interesting conference that will last for 2 days. On the 18th of November, we will be all in Munich for Semicon, and we will hold the first session, the first edition of the CHIPS Venture Forum. It is organized by Access in collaboration with EIC and DG Connect at the European Commission. So here we will have a pitch of startups, but not only, we will have also panel discussions from corporate venture capitalists, and corporates. So I hope to see you there. And on the next day, on the 19th of November, I had the pleasure to be invited to contribute to a panel discussion at 12:40 in the executive forum of Semicon. It will be in hall C2, so if you happen to be there, it will be great to see you. And during the whole conference, during the whole Semicon conference, you will have the possibility to meet Access, but not only, you will have also all the pilot lines which are listed here on the left of the chart, and also EuroCDP, which is the European chip design platform, and also the 3 industry associations. So we will be at booth C2417, hall C2, very close to the executive forum. So make sure to say hello. So this webinar is an interactive discussion. You can enter your questions in the chat. You can react in the chat. We'll try to save some time for questions at the end of this session. If I see some interesting comments during the discussion, I will make sure to share it. So let's start with a very short interaction. We would like to know a little bit more about you. So tell us about you. Who are you? Are you a startup? Are you part of an investor, venture capital investor? Are you part of the CHIPS Competence Centers? Are you a large company or none of the above? And then you click on others. So while the people are filling this chart, in fact, let's start to discuss a little bit about Jolt Capital and yourself. So welcome again. Thank you. So people don't see us for the moment. It's normal because I'm just filling in the chart. So welcome again. I think I can close the chart now. And I can show the results. So we have today 44% of startups 10% of investors, 20% of chiefs competence centers, 8% from large company, and 17% from others. So mostly startups, and I'm sure you will see a lot of interest into this discussion. So yeah, welcome again, Jolt. Thank you again for being with us today. So before we go through your analysis of the semiconductor industry, can you introduce us to Jolt Capital in a few words?
Yeah, of course. So thank you everybody for being there and listening at that conference. So I hope it's going to be interactive. And thank you, Regis, for the thoughtful preparation of it. So in a nutshell, Jolt, I created Jolt 15 years ago, and the idea didn't change since then. So the whole idea is to fund companies which are growth stage technology companies in Europe. So our main objective is to find those companies which are 10 to 50 million euros in revenue. EBITDA is another debate, but it can be negative, of course, because at that size anyway, EBITDA doesn't matter so much. But we are looking at those mid-sized companies and to fund their growth. So taking them from, 15, 20 million to 100 million. So we are currently deploying around 150 to 200 million a year. Our upcoming fund, which is going to be invested, we are going to start investing that fund in end of 25 is close to €1 billion fund. And so we have sizable amounts of money to invest in deep tech companies. And within that spectrum, semiconductor represents the largest portion of the money. So we do invest in medical device and AI. We do invest in materials which are not always semiconductor materials. We do invest in technical software which are not always technical semiconductor software. We invest in mobility and energy management, but semiconductor represents anywhere between 30 to 40% of that money. In our previous funds, it was the same proportion. And we always had been bullish about semiconductor in Europe because there is a lot to do here because we never lost any money on semiconductor, so we like it a lot. We always made money there, and I think there is a kind of a way to invest which works. So we are a team of 42 people. Again, we manage around 1.5 billion. We are entirely focused on Europe. We have offices all over the world. We have people in the Bay Area, in Boston, in Montreal, in Seoul, in Tokyo, in Singapore, and across in Europe as well to support our companies and support their growth. So that's a quick introduction.
In semiconductor, are you looking at more specifically fabless companies, photonics, or equipment, or design, or anything works?
We are in Europe, so we need to go where we can operate successfully. So we are quite excited about IP companies which are licensing IP. We like a lot, and we can talk about that later, capital equipment, where of course everybody is explaining that capital equipment is cyclical, is awful, blah, blah, blah. But it's actually, like any business. But this is actually a business we keep liking if there is significant IP, of course, and a thoughtful strategy. We photonics, of course, because photonics is in a way the semiconductor of the poor. It's a little bit less expensive to have a fab in photonics than a 2 nanometers fab. Fabless, I kind of didn't answer that. We are careful on fabless because we don't like this dependency on 2 nanometers fab, and spending $1 billion to do a new AI chip is dangerous when you don't own the fab and when you're not co-located with the fab.
Okay, co-location is very important that's because of the geopolitical tension, right?
Yeah, and you mentioned a key word which was pilot, with your network across Europe, and those pilot lines are critical. If we don't see a pilot line, or if we cannot establish ourselves, which we did, a pilot line, there is no way to be here having an R&D center in Europe and believing that the other guys will be stupid enough to just do the manufacturing.
Okay. Can you mention a few companies that some success that you said that made only money, so you must have great track records. So can you give us a few examples of successful companies you have invested in?
Of course. So briefly, recently we sold the company Unity SC, which was a metrology and inspection tool company. So we were inspecting all sorts of things. What was innovative in the company was a sensor and a software. This fusion sensor we put together and the software were great. All that was packaged in a machine, which was, of course, a big robotized machine. Was $1 million a unit, roughly, and we started selling that like everybody. Initially as a pilot tool, R&D tools, and then we went into lines, and then we went into full production, controlling, for example, any single NVIDIA chip at TSMC. So we sold quite a bit of machines. It was an interesting venture. The technology was very innovative. The capabilities of the company were really miserable. So we had to acquire a company with serious capabilities in Germany, another one in France, which gave us these clean rooms, the processes to build the proper machines, build a partnership with a good subcontractor in the Netherlands to do the final assembly and the quality control, and all that together formed an ecosystem for that company, which was meaningful and allowed us to sell the company, by the way, to a European player, because we sold the company to Merck, which is a big pharma, but also a significant player in the semi space. I can give you another example, which is fun, which is a company called Heptagon. And that's a company which it's a perfect exercise in strategy. Those guys were selling optical elements, which then were packaged with some semiconductor sensors in order to do optical modules for iPhones or for cell phones. And at a point when we invested, we said, guys, we need to stop that. We need to not be providing our great optics to people packaging us, but we are going to become an advanced packaging company. And we started to build some very advanced packaging, especially things like the facial recognition of the iPhone, which is a very complex package. It's a VCSEL going through a diffractive element with a lens and a CMOS sensor, all that in a teeny package, which of course doesn't have any crosstalk if possible, and which is very safe because you don't want to beam a laser beam into the eyes of your customers. Turning your customers blind is not good for business. So we produced those for the iPhones. And that was multi-billion contracts. So that company went from 100 people when we invested to 10,000 people when we sold the company, and it scaled quite a bit. So that was also a very good deal for us. But you have many others. I'm not going to talk about any of them.
You mentioned capital equipment and also advanced packaging as a technology. And we'll see later in your slides that those specific two elements are especially maybe less invested. But the important point is that you mentioned advanced packaging, but it's not a company which is centered or centric on advanced packaging. It's more kind of verticalization of the company with advanced packaging, broad value to the company.
Yeah. Building a generic company in advanced packaging is very exciting, but much more complicated, expensive, and challenging. One vertical application looks like nothing, but the factory itself was a $400 million factory. So it was not cheap to put that thing together. Of course, we were doing much more than facial recognition. We were doing all sorts of infrared sensors and presence sensors and colorimetry sensors and so on. But that said, you're absolutely right. It's a great comment. It's a verticalized packaging company we had.
Okay, so thank you very much for this first insight. So we're going to talk a little bit about your process in investment, because you have an internal process which is powered by a specific tool that you have developed in-house. So can you tell us a little bit more about this tool?
Yeah, I think it's going to be helpful for everybody to understand where the data I'm going to talk about, going to comment, then is coming from. At Jolt, at the very beginning, when we came and explained we are going to invest in late stage deep tech companies across Europe, people were laughing at us, telling there are not enough, the market does not exist, or. So we designed this tool, which is called Ninja, and Ninja is collecting data from the internet and trying to detect deep tech companies. So today that platform became very large, and Ninja is discovering one new company every single minute. And during that minute, this same minute, we are updating around 1,000 business plans, or business cases. So it became a very large database. It's a large graph describing business, including patents, people, relationship between companies, funding, activities, whatever you name it, all over the world. So today we have 5 million technology companies in our database. This is actually the largest database in the world. We don't sell it, but we use it for finding deals, for doing M&A, combination of companies, build-ups, and so on. And of course, we added all sorts of AI gimmicks in it, virtual analysts. We don't have many junior in Jolt because this platform does the job. But also, since we have a lot of data, we can now kind of comment the size of the markets and how to target the quality of IP and so on. So and this is what we are going to talk about. We are organizing our own strategy on Ninja, but many others as well. So you would have Temasek in Singapore, you would have people like EIC in Europe, or the French government, or many other funds are using Ninja today. We are not jealous of this data. I don't believe in data you keep for yourself and you just use that for your own little business. I'm a strong believer in the network effect and of sharing that data in order to form a community of investors. I think we have 25 funds across Europe using it today. By the end of 26, we will have 100 funds. And I think it's a good of everybody, investors, entrepreneurs, everybody will benefit of having a more transparent market.
So for our audience, from now on, the slides that I'm going to share are coming from an internal study from Jolt Capital. I see that there are already some questions in the audience about the pilot line, so I will take that later. But let's go now into your internal study, and the first stop will be an analysis you did on the global semiconductor investments. And I'm showing now this slide. So yeah, if you can elaborate on explain what we're currently seeing, because we see a huge investment leap from 2020 to 2021 here.
Yeah, what you are looking at here is the investment. So is the VC, the venture capital and the growth investment in semiconductor. And here it's a graph which is worldwide. So you see that there is an uptick of investment starting in 2020, and AI is a part of that investment, but not only. And the VC and growth investment had been quite sustained during the last few years. So this is boosting innovation. This is boosting the number of companies. We will see that later. You also see on the middle graph, you see the evolution of the share of between the different regions in the world of that money. So Asia is capturing a bigger and bigger share. Europe is very modest, and the US is capturing a lower share. And you will see that over and over. Asia is taking over in terms of AI, in terms of semiconductor now, in terms of money, and you will see in other domains. Europe is, I would say, supporting its own industry, but not developing it. So we are mediocre, but at least we keep as medium size as we are, so we don't shrink, which is a performance because the US is shrinking significantly, as you can see that. So we talk about very large amounts of money. We will talk also about the reason why Europe is not developing. There is a very simple reason why, but today we keep operating nevertheless. So we are not in a desperate point. We don't develop our business as we should.
But it's 25% of the deals in volume, the number of deals, 1/4 of all the deals are made in Europe, but for only 10 million. 10%.
Yeah.
So it means that the size of the rounds are smaller, right?
So the size of the rounds are smaller. If we compare ourselves with the US, in terms of number of deals, and it's true for semi, it's true also for any other metric or any other domain, you would see that Europe did catch up in venture capital in number of deals. And if you divide the amounts of money by GDP, Europe and the US are doing similar efforts now in venture capital. Of course, in absolute dollars, the GDP of the US being much higher now than ours, they are spending more dollars. On the other hand, US is much more expensive as well. So I think dividing by GDP is kind of creating a better comparison. So in venture capital, we are kind of comparable in terms of efforts. Where we have an issue is on growth capital. So, but that we will cover that later. But yeah, we do a lot of deals. You're right, and in a way, we are creating a lot of companies. What do we do then? Is the question.
Okay. Okay, so let's move on. Then the next stop is for the European Semiconductor Investment Universe. Yeah, can you explain? You did here a study on 3,000 companies which are mentioning AI, right?
Yes, exactly. So of course, now AI is kind of the current buzzword for many things, for B2C applications, of course, but for semiconductor people, AI, of course, is a real concern, and we see the opportunities in AI. They are all over the place. They are in lower geometry, they are in power management, they are in creating chips that are much less power hungry, and by you see people, and they're not all. We cannot mention all of them or any of them, but you see companies which are now doing AI chips, which should be 100 times to 1,000 times less power hungry than what you would have with the current technologies. So of course, those are game-changing semiconductor chips. So being in capital equipment, being in IP, in power management, in chips themselves, in fabless, in whatever, this is critical. And we try to look at where people talk about AI, and it is a little bit disappointing in a way, because being in marketing or being in positioning ourselves in AI, it's a little bit low, as you can see. So if you go to materials, I'm not surprised. Manufacturers, I'm not surprised. Backend, I'm not that surprised. When you go to capital equipment now, of course, geometries are shrinking, so you need new tools. Like, here we mentioned near field, which raised quite a bit of money. There are others as well in the same field. So whatever is sub 2 nanometer needs to mention AI to explain why they go sub 2 nanometer. And capital equipment is more and more mentioning AI. They're also mentioning AI for their own capabilities, because of course, people start using AI in fabs. We always used a little bit of pattern recognition and so on in fabs, so it's not very new. I think we are expecting people. It's also on EDA and also in factory management tools. We're expecting people who are going to give us much more new innovation in terms of AI within the fabs. You see the fab as a lot of sets of silos which are not connected. If you want to do much better, we will have to connect those silos and have some AI on the top of it. But
Right.
But on capital equipment, they are not interconnected that well in reality, but we see that it's a domain. In design and fabless, of course, we see a trend growing here, and in EDA, it's kind of correlated. But still, 12 to 14% is very low. So
yeah, I was surprised by this number. So I would expect much more marketing around AI from startups. But doesn't seem to be the case. So is it enough? Should we have more? What do you think? Because we're also talking about this AI bubble coming. So
yeah, between you and I think that the European companies in semiconductors suck in marketing. So they are not using the buzzwords as they should. So to me, someone coming with the capital equipment in metrology or in inspection, not talking about AI, give me a break. Yeah, okay. Sometimes I see companies using the old words. I'm an AI guy, so I was hiding when I was young because, it was in the 90s. In the 90s, you wouldn't talk about AI because those were bad words. So you were talking about statistics or data mining or whatever you name them. Now it's prime time for AI. Not using those buzzwords is basically decreasing the valuation of the company and making companies less attractive. So I think people should think a lot about how to promote what they do and how to make their case, and even publishing scientific papers and so on why AI is boosting them makes all the sense of the world.
Yeah, maybe not claim that they are an AI company, but how they use AI and how they even promote their product to AI.
Yeah,
right?
yes, I think that the bubble in AI, which we are witnessing right now, is a bubble which is due to a usage an adoption by consumers of AI. So, AI had been there, will be there, and is evolving and so on. Are LLMs going to take over the world? Absolutely not. Is it a great milestone as foundational models? Absolutely yes. Now, we can dispute that a guy like OpenAI is that a great company. They lose after all $1 billion a month, $2 billion per month. So that's quite a bit of money. And of course, the semiconductor industry thanks OpenAI for their business, but they're still losing $2 billion a month. So it might be a bubble that will explode on B2C, but I think that on B2B, it's not a bubble, it's a trend.
Right.
And if there is a kind of an uptick in valuation right now, let's enjoy it.
We need to split between B2C and B2B. So I suggest we move on now with the next stop with how fast companies are raising funds, according first from the date of inception and from their geolocation, where they're located.
Yes, that's so it's a very simple, it looks complicated, but it's very simple. Here, the idea is that we took all the companies and we said, how much money do they raise year 1, year 2, year 3, year 4? And we put different curves, which are showing what happened to them depending on their date of birth. So you see the solid curve in blue, which is the 2022 vintage, so the companies which were born in 2022, and you see their investment trends. So that's the latest one. You see that in the US, you have the other two curves which are starting in the same way. So in year 1, year 2, they raise 20 million very fast, and then the 22 to 2022 cohort raise much more after year 3 because the AI bubble is pushing them up. But all in all, if you compare Europe and if you compare US, you have this year after year, you have the same message. Right. The US companies are raising much more money, much faster than the European guys. We don't want to drive too quick conclusions, but I will comment that. But what you see is that after year 4, in average in the US, the guys raised around 60 million, while the European in average went to 20. So we are in a tough spot. Let's not drive too quick conclusions here. Having tons of money is good, but let's not forget that our US companies waste a lot of money as well. They pay people 3 times the salaries and so on. So it's not always well invested money. So not everything is related to money. That said, it is very clear that on year 4 or year 5, you end up having. We didn't put year 5 because it gets off charts almost at a point. But what is surprising here is that gross capital in the US is pushing a lot on semiconductor, while you see that gross capital in Europe does not intervene before year 7 or year 8, and actually. We see that as Jolt. Many of the companies which we look at are 7, 10, 20 years old sometimes. So it took a while for them to get to a reasonable level of revenue, while in the US it goes much faster. So
Is it
capital in
because
the
they
US.
have access to the US market, or is it because they are local?
I think that the corporates are much better corporate citizens. So, in Europe, our corporates are not desperate, but they are focusing on themselves. So the ST Micro, the Infineon, the NXP are around. They do work with their ecosystem, but not that much. While when you're in the US and you are next to the TIs, the Intels, and so on of the world, they're investing massive amounts, and they are co-investing massively, not to mention things like DARPA and so on, which are pushing companies to grow much faster. So not to put pressure on corporates, DARPA, here we didn't put the contribution of DARPA in those graphs, but it is very significant. In Europe, we give grants. DARPA is not giving grants. DARPA is giving contracts. So you get real revenue out of those contracts. And that's a game changer for companies. They learn how to use that money to achieve something as a supplier, not as a grant to do research. So those differences are very much in those numbers. Would I see companies doing 20 million based on research contracts and so on? As an investor, I would consider that as true revenue, not as grants. So it's a different animal they are forming thanks to their own way of organizing their business. Europe is underfunded, clearly. Yeah.
Okay. So 4 more years for a European startup to reach roughly the same level as a US company.
Yes. And you see that the AI bubble. Sorry.
Yeah, go ahead.
Yeah, you saw that the AI bubble did hit the US semiconductor sector because the increase of amounts invested grew quite a lot in 24, 25, while in Europe, the AI bubble did not hit funding.
Right, that's true. Yeah. All right, so there's now a concept that you call the hidden universe. So can you elaborate about what is this hidden universe and is it worth of investment?
Yeah, it's the idea we are cold-blooded investors. So my job is to invest at a great price in companies and sell them at a much higher price. So when I look at the market, the one thing nobody likes is competition. So there is a place in Europe, which is what we call the hidden universe, which is like our Shangri-La. It's the place where no VC, no private equity ever invested. So you have plenty of companies in Europe which made it without any private equity money. Those are the best ones. Those are the most interesting ones because those are the guys who could survive probably doing uninteresting deals in order to fund some interesting technology, or they find ways. And those are great survivors. So per domain, if you look at the little graph on the right, per domain, you see that 55% of the AI related companies, AI, are funded. So 45 are not. When you go on devices, 48, manufacturer, 44, design and fabless, 44. So, which are backed by VCs. So already here you have a gigantic universe of companies which are doing design and fabless, which are not funded. And if you go down, you will see that semiconductor materials are less funded. When you go to EDA, almost nobody, 36% of the companies only are funded. And when you do to capital equipment, as you mentioned it before, Regis, 29% of the companies on capital equipment backend are funded by VCs. So in other words, if you are a capital equipment company, you had better count on yourself because there is little money available. For us as investors, I like a lot those graphs because it tells me where I should go to find companies which are good at surviving and navigating turbulent waters.
So if I'm a capital equipment company, I put a little bit of AI in it and I survive for 7 or 8 years, I can knock at Jolt's door.
Absolutely. In fact, if you come to me with significant IP, so good patents, a set of families, and a decent business, so the if you want the recipe to be loved as a capital equipment company, the recipe is the following. You have 20 families of patents, you do 12 million, you have a niche product, and your niche product is starting to get into production and is already out of R&D. So, of course, if you sell one machine to IMEC, one machine to A-Star, one machine to Leti, you are not yet in business. You are just kind of a potential business. If you sell 2 or 3 R&D machines at large fabs, it's still R&D machines. We know what it is. You are going to lose money forever doing customs. What we want is someone telling you, hey, I'm going to buy 4 of those machines, even if it's a small production. Then we love you. You're in business. Then you are going to take great care of you because we believe there is something to scale. And the other recipe is that don't try to kill the big guys. You kill nobody in the semiconductor world, but here I'm in front of a lot of people who know this sector much better than I. You kill nobody, you disrupt nobody. It's the reason why actually we like semiconductor as well. You contribute. So your job here is not to go to Lam and tell Lam, I'm going to kill you. That's going to make them laugh a little bit. It's like, Lam, you don't look at that niche because it's too small for you. We bet on it. We moved from 0 to 60 million in revenue, and now it's no more a niche, it's a market. We own it. We are better than you here. And you don't need to finish the sentence. They will finish the sentence themselves. And I'm going to buy you. And they're going to buy you for 5x revenue because they pay the price. So this is what I like about semiconductor. You don't need to destroy an entire market to be listened at. In many venture-backed domains, you are building a small village on the ashes of a big city, which you destroyed. And that's a very barbaric way of doing business. In semiconductor, it's never like that. You're adding your piece to the global construct. So that said, you see that the VCs and private equity people don't do the job in Europe. The capital equipment is underfunded. EDA tools are underfunded. Give me a break. How can that be? Because Cadence one day said, I'm not going to buy anymore. Everybody went out of the market. There is so much to do in EDA, especially now with, AI software development coming in. The currency software is collapsing. So before, the cost of 1 million line of code was huge. Now, the cost of 1 million line of code is a joke. So there is an opening for building new tools which are incredibly effective, addressing new needs with relatively low cost of creation. So it's a good time for software people in semiconductor to kind of take off and come in. So this is the job here.
So let's talk now a little bit about patents. Again, you have developed an internal metric. We will not get into the detail of the score that you have developed, the Jolt patent score, but let's take it for granted that it's a great score, and we believe it.
Yeah.
So can you explain the graph on the right, which is really extremely interesting?
So, and just to give you one little thing about this IP patent, when you mix in a proper way the age of a patent, if it's old, it's not that good. It's not anymore that valuable. If it's very young, it's much better. If you are quoted, if your patent is quoted by many people, it's kind of better. And if you are quoting many other patents, it's not a great patent. So if you have a patent, I think we would all agree, if your patent is quoted by 1,000 other companies in their patents, and if your patent is brand new, and if you're quoting no other patent, you probably invented something cool. So that's how this patent score is calculated. And by the way, it is we validated with the European Patent Office and so on. So it's not like brain juice coming from.
We believe you.
Yeah. So
it's a great score. We believe you.
now that you believe me, let's go onto that graphic. And that graphic, and I like the darkest lines here. The darkest line is showing you the 5% proportion in the world for each region of the world. So North America, Europe and Asia, of the top 5% patents available. So what you see is that in the US, in 2010, you had around 70% of the top 5% patents in the US. So US was actually almost in an IP monopoly situation at that time. And Europe had around 23% of all patents in the world on the top 5% patents. So we were not nowhere. We were above Asia, actually, which was the number 3 owner of top quality patents. What happened over the last 12 years is that the US went down in their proportion of high quality patents. Asia went steeply up, and Europe stayed stable. So it reminds you a little bit what we discussed about regarding startups. It's exactly the same. The amount invested in company went down in the US, went up in Asia, and stayed stable in Europe. Same with inventory of companies. So we are a kind of not moving up in our market share, in our brain share, in our capabilities. We are not going down either. The US is going down quite a bit, taken over by Asia. And I'm hearing very often, Chinese, they patent everything and nothing, and they are favoring quantity above quality and so on. Look at it. It's not true at all. In the top 5% patents in the world, China is kind of taking off.
And the graph shows that the trend up to 22. We are in 25th, so almost at the end of 25th. And we will see soon the cross section between Asia and US.
Yeah, it's going to take a few years more, but in 10 years from now, if the trends continue that way, we will see China taking over above the US. And that's going to be another big shock for the US. They want to own their semiconductor business, and they are clearly losing ground. It's going to be a very big issue when the US won't be dominant anymore in IP, because they will have to deal with China, or they will have to ignore what is a patent. But that's a much bigger discussion. Europe has a good... Europe, we are not. One of the message here is that you see that Europe is not number 1, but you are solid number 3, stable, which is already good compared to if you consider how much money we are investing.
All right. Now the last stop before we take some questions, we're talking about the market performance, and that's more about the exits. So we see here some trends, some ups and downs. Some organizations are stable across the years. Can you elaborate a bit on this graph again?
Yeah, that's of course for investors and for entrepreneurs we have in the call. It's really important to see those graphs, because this is how you value your companies. I know that everybody talks about unicorn and blah, 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 but the valuation given to you by a round of financing is meaningless. What matters is how much money are you going to get the day of your exit. This is the graph which is actually completely directing the valuations of an exit. So this average trading multiple is the average multiple you can get on your sales. So basically, you see that it went to 4x in 2018 to now 4.6x. It went a little bit up in 21. 21 was the heydays of any investments. It went up to 5 or 6. So all in all, the valuation of the semiconductor companies, the valuations are high. So just give you something in perspective. Everybody believes that SaaS companies are very, very well valued. In reality, there are 2 buckets in the SaaS business. You have what's called on-prem, where the software are run on a private cloud, and you have the pure open SaaS companies. Open SaaS today is in average trading at 4x. On-prem is in average trading at 7x. So pure SaaS companies are in average trading less than semiconductor companies. In fact, semiconductor companies which do well are most of the time operating at 45 to 60% gross margin. So in optics, you can get even higher eventually. So we are actually not that far from the software companies in terms of gross margin. Of course, the hyperscalers are getting more and more expensive, so the SaaS companies are losing gross margin because they pay for the cloud more and more money. In our case, in semiconductor, the valuations are actually very attractive. It's a well-kept secret, so investors, for whatever reason, never look at that. But this is a rich market, and for all of you guys, you are in a good market as far as you do revenue. A zero revenue company is not worth much money today. It's a falling knife until it does actual revenue with actual customers. But this graph is actually full of hope for us. As investors, I keep looking at it, and I keep looking at high valuations. I mentioned, I'm looking for software companies, simulation, EDA, and so on. Look at the valuations. They had been in 7x forever since a few years. So it's very attractive domain if you can do a software company for the semi industry.
Right. Again, we see the difference between the domains with AI being at the top and the materials being more at the bottom. Right?
Yeah, materials are less trading less. They're usually also companies which are bigger, and they are less attractive because they are based on patents which are complicated. In fact, you need to be explained what your company does in a relatively simple way. Otherwise, your valuation will always be a little bit more challenged. We are suffering, of course, in semiconductor because John Doe will never understand what we do, and not to mention a journalist or a politician. So we need to simplify. A little story is that when we talked about take an example like Nilt on that exit. This is a company which we sold in January this year. And Nilt is a company which is doing optoelectronics. They do, in fact, they had 100 families of patents on what's called meta lenses. So it's a nano imprint lithography, and you try to create little constructs that are manipulating pieces of wavelengths of light and play with the waves in order to slow them down or make them do some crazy things. So those meta lenses are incredible because you can replace multiple optical elements in a fisheye, for example, by one flat lens, which does exactly the same, but with a much better quality. So that company, what I told you here is completely impossible to explain to John Doe. So it was a company which was considered as a bunch of nerds. We started selling the product because the quality of the product was exceptional. So we started having early businesses. We scaled the fab in a pilot fab in Denmark, and then in Switzerland, and then we scaled a medium-sized fab in Malaysia. And we went acquired by Radiant, which is Taiwanese. In fact, Radiant bought us because Apple told Radiant buy them. So it's it's just an industrial move. But when you consider that, it's the company became sexy when Apple name came in. So when you have a B2C, a consumer brand, which is putting its name on a semiconductor product, suddenly it gets sexier.
Right.
ASML, for example, never made it really to the public because what they do is super complicated, and whatever they do as efforts, it's impossible to understand, and they don't have someone like Apple telling, "Hey, I'm ASML partner." So now that they work with NVIDIA and so on, they might have some level of sexiness again.
We are reaching the end of this discussion. We have 10 minutes left. We are a little bit behind schedule. So we have a few interesting questions that we'd like to ask you. But before we got into that, what about the CHIPS Act? What do you think of the impact of the CHIPS Act?
So the first CHIPS Act, I must say that I didn't see much the consequences on our portfolio companies or on the startup market. It didn't go that far, probably. those are important acts. We need them. We need them to percolate to mid-sized companies as well. That said, we can do whatever we want at public level. We won't be successful if the real money doesn't come. Let me give you two numbers, which are super simple. Pension funds in the US invest 3% of their assets under management in technology. And that started in the 70s when they started funding Kleiner Perkins and Sequoia and so on, and all the Googles and all those guys took off. In Europe, we can run a survey, but the amount which is invested by pension fund is 0.025%. So it's a factor 125. So we can scale, we can kind of create as many companies we want with venture. If this 125x multiple is not kind of fulfilled, if we don't start putting some money in the machine won't take off. And we can tell whatever we want with NXP, with Into Infineon and to ST Micro. Those guys are heroes. They managed to survive in a place which doesn't help much. And CHIP Act is fantastic because I think it's opening the eyes of those guys, those pension funds, which today are putting all their donuts in the US in order to fund our competitors who are killing us. We need to stop that. And I hope it will. I think that EU is fully aware of that. Governments are fully aware of that. But they really need to change their behavior. We cannot have our pension money invested against our own continent. That doesn't make sense.
Okay, so that was for the CHIPS Act. And now I'm going to challenge you with a couple of questions coming from the audience. The first one, which was asked at the very early stage from someone from IMEC, from Giuseppe Fiorentino. Can you elaborate more about your vision about the role of the CHIPS pilot lines in Europe? Are you aware of the CHIPS pilot line? The pilot line from which is one is working on SOI, the other is working on sub-2 nanometer. So one is on packaging, there's one on photonics, power electronics. So what do you think of this instrument? They cover quite a broad spectrum of technologies. Which ones you believe may hold the highest potential?
Thank you for the question. Now, I'm going to answer from an investor perspective. So from a money guy, we need those for me. Without pilot lines, we have nothing. So we need them bad. Now, what we would need also is to be able to collocate fabs and industrial grade equipments next to those pilot fabs. I'm a little bit sad when I see that in Saclay, for example, we can do a lot of research, but there is no real estate for building a factory. In fact, it's forbidden. So the guys probably didn't read the story of the Silicon Valley and where people made money on real estate. So we need the ability to build fabs not far from those pilot fabs. The other thing is sometimes they are much too expensive to use. And I think that the scarcity of pilot lines is turning sometimes into a business, and that's not good. I won't mention the name, but we have one of our company which is on a pilot fab currently. They pay a price which is around 5 times what they would pay in Asia. This is not serious. The other thing is we don't have enough pilot fabs. So guys, please do more. We need more. Why? Because when you have 6 companies working at the same time on the same kind of lines, you spend your life reparametering everything. I know the example of NILT, which was using equipment in the university in Copenhagen, was complicated. You had some people passing by, and you had to recalibrate everything every other day. It was a nightmare, and we had to buy our own e-beam machines, which I still remember because I did the check. That was expensive, so we need those pilot fabs. CISEM in Switzerland was very helpful in some cases. We need them, and I think the private sector and the public sector here is not collaborating at, for example, forming new pilot fabs for the good of all. and I would be very open to that.
Yeah, you mentioned pilot fabs. You mean actually producing some products that you can sell, right?
Yeah, it's more sell or demonstrate,
Okay.
but good enough. So let's say industrial grade products in low quantities. As much I'm very European and I would love to scale factories in Europe, but sometimes we don't have time to scale. But if you established your R&D next to your pilot lines, it's how you create great products, and then you can scale a factory in Malaysia, in China, in Vietnam, in wherever. It's not that I don't care, but you can scale anywhere in the world where you need a workforce and so on, which are more flexible than in Europe. But if you keep your pilot fab next to your R&D, all the IP you create will be located in that place. And where the IP is where the revenue is, after all, and where the taxes are.
I will take the next question, which is about the root cause. We talked about the European IDMs, which were not working so much with European startups, and unlike American players. So what do you think is the root cause of that? Is it cultural? We don't trust European tech? So what do you think?
Let's kill a bunch of things. We have plenty of entrepreneurs. In fact, if you look at the number of companies in Europe which have one patent, 50 to 500 people, employees, and which have a very high, let's call it deep tech score, we have 6,500 of those in Europe and 6,000 of those in the US. So we have more mid-sized technology companies of high quality in Europe than in the US. So we don't lack of entrepreneurs. We don't lack of courage. Our entrepreneurs are much more courageous than in the US. We need to do the same with less money. So we must be really, really good. So we have entrepreneurs. They are really good. We have the quantity. In terms of IP, as you see, we are not on the decline. So we can leverage our IP. What is missing is growth capital. So we need to be very careful. We don't want to spend more money in venture. We have enough venture money. If we put more money on venture, we are going to create more companies. And as you know, talent is creating money, but money doesn't create talent. So if we push more money, we are going to see crap companies kind of appearing, and they're going to waste good money. Now, what we need to do is to put many billions at work at growing our companies. And when I mean many billions, you don't talk about 3 billions or Jolt fund at $1 billion. This is petty money. But our lack of money is in the region of 200 billions a year to be invested in our companies. And guess what? The money is available. It's in pension funds. Today, we invest in the US. Every year, the Europeans are investing 350 billion of their savings in the US. The Americans are investing 150 billions of their savings in Europe. So let's call it Liberation Day today. I thought it was a kind of a good idea from a guy I heard about. And we do the same. Liberation Day, you know what? We are going to spend 200 billion on our own economy and just reciprocate the investments from the US. They send us 150 B, we send them 150 B, and the 200 B in excess, we put it in our own technology, and we are going to own the world. So that's what we don't do today, but it is as simple as that.
All right. I'm wondering if we are reaching the end of this session. We still have 1 more minute. So I think that the best for now is to think about the Chief Venture Forum. We will meet again on the 18th of November in Munich. So I want to thank you very much, Jean, for your insights. There were many questions in the chat that I cannot share with you, unfortunately. But I want to thank all the participants. We had a big audience today, and you remained all the time. You have been very participative. So I hope you liked the show. Thank you very much again, Jean, for your valuable time. It was a real pleasure to have this discussion with you today. And this webinar will be available on our YouTube channel very soon. So thank you very much, Jean, and have a good day. Bye-bye.
Thank you, Regis. Thank you, everybody. Bye-bye.